If I told you that you could predict exactly when your money will double, down to the year, would that change how you invest? Of course it would, because suddenly you're not just throwing money into an account and hoping for the best. You're building a machine where you know every gear, every speed, and every lever you can pull to make it run faster. Most people will save for 30, 40 years, and still never actually double their real purchasing power. Not because they did something wrong, because nobody told them the 5 factors that control how fast doubling happens. And one of those factors, the 5th one, has nothing to do with math at all. Stay with me. Here's how most people think about investing. Pick something safe. Put money in. Wait. Hope. That's not a strategy. That's a lottery ticket with a suit on. The people who build real wealth think differently. They treat compounding like an engine, and they know which dials to turn to make it faster. So let's break down the 5 factors that control your doubling speed, starting with the one that changes everything. Number 1. The rule of 72. Your doubling calculator. Understand the tool that makes this whole thing work. It's called the rule of 72. And it's so simple you can do the math in your head in 3 seconds. Take 72. Divide it by your annual return rate. The answer is how many years it takes to double your money. Earning 8%? 72 divided by 8 equals 9. Your money doubles in 9 years, earning 12%. 6 years. Stuck in a savings account at 1%. 72 years. You'll be doubling your money somewhere around age 100. Now, this isn't some random shortcut. It's based on the mathematics of exponential growth, and it's been tested against real investment data for decades. For returns between 6 and 10%, where most long-term investors land, it's accurate within a few months. But here's what most people miss. The rule of 72 isn't just a calculator, it's a targeting system. Because the moment you know how long each doubling takes, you can start asking the right question. What would it take to shave 2 years off each cycle? Let me show you why that question matters so much. Say you start with $10,000 at age 25 and you earn 7% annually. Over 40 years, your money doubles roughly 4 times. You end up with about $160,000. Now change one variable, earn 10% instead of 7. Same starting amount, same 40 years. But now you get 5 doublings instead of 4. You end up with $320,000. 3% more return, twice the final wealth. That's the power of shortening your doubling cycle. Number 2. Inflation, the silent thief. Your nominal return is what you see in your account. Your real return is what actually matters, because that's what measures your purchasing power. Here's the trap. Say you're earning 6% in a bond fund. Sounds decent. The rule of 72 says you're doubling every 12 years. Good, right? Not so fast. If inflation is running at 3%, your real return isn't 6, it's 3. And at 3%, your doubling time isn't 12 years, it's 24. You thought you were doubling every 12 years. In terms of what your money can actually buy, it's taking twice as long. The data on this is clear. From 1926 to today, average US inflation has run around 3% per year. The S&P 500 has returned roughly 10% per year over that same period. So the real inflation-adjusted return? About 7%. In nominal terms, your money doubled every 7.2 years. In real purchasing power, every 10.3. That 3% inflation gap cost investors 3 extra years on every single doubling cycle. Not once. Every time. For every decade they stayed invested. This is why chasing returns in a vacuum is dangerous. You have to think in real terms, because money that doubles on paper but can't buy more than it did before isn't growing. It's just keeping pace. And keeping pace isn't wealth. Number 3. Fees and taxes. The compounding drain. This is the one that quietly costs people hundreds of thousands of dollars. Every dollar you lose to fees or taxes is a dollar that can't compound. And the cost isn't just that dollar. It's every future doubling of that dollar. Let's run the numbers. You have $100,000 in a fund charging 1% in annual fees. Over 30 years at 9% gross returns, that 1% fee doesn't cost you $30,000. It costs you $64,000 because you're losing the compounding on those fees every single year. Now add taxes. If you're in a taxable account paying 20% capital gains, Every time you rebalance, you're effectively cutting another 1 to 2 points off your return. Combine fees and taxes, and what looked like a 9% return becomes 6 or 7. Your doubling time just went from 8 years to 10 or 11. Over a 40-year career, that's the difference between 5 doublings and 4 doublings. An entire extra cycle. Gone. This is why tax-advantaged accounts like 401ks and IRAs are so powerful. They don't eliminate taxes. They delay them, letting your money compound without the annual drag. And it's why low-cost index funds have become so dominant. A fund charging 0.1% instead of 1% hands you back almost an entire percentage point of return. Over decades, that 1 point can represent hundreds of thousands of dollars. But here's the thing, even if you do all 3 of these things right, the 5th factor can erase all of it. We'll get there in a minute. Number 4, contributions, the compounding multiplier. Most people think compounding only works on money that's already invested, but every new dollar you add starts its own doubling cycle. Immediately. Here's the difference. You start with $10,000, earn 10% and add nothing. After 29 years, about $160,000, 4 doublings. Now run it again. Same return, same period. But you add $500 a month. After 7 years, your account is at about $85,000. After 14 years, around $230,000. After 29 years, over $1 million. Same return, same time. But by adding regular contributions, you went from $160,000 to over $1 million. Because every contribution you make starts its own compounding journey. The $500 you invest today will double. The $500 you invest next month will double. And the earlier contributions get more time to run through multiple doubling cycles, while the later ones are just beginning. This is why starting early matters more than most people realize. It's not just about giving your initial investment time to grow, it's about giving every single contribution the maximum possible time to compound. Someone who invests $500 a month from age 25 to 35 and then stops will typically end up with more money at 65 than someone who starts at 35 and contributes until 65, even though the second person put in 3 times as much money. Number 5, discipline. The only lever that's purely psychological. This is the hardest factor, and the one that destroys more compounding than all the others combined. Discipline. Compounding only works if you let it work. The math is perfect. Humans are not. The moment you panic during a market downturn and pull your money out, you break the cycle. You stop the doubling machine at the exact moment it needs to keep running. The data on this is brutal. Studies consistently show that the average equity investor underperforms the market by about 4% per year. Not because they picked bad funds, but because they bought high, sold low, and constantly interrupted their compounding by reacting emotionally to headlines. Think about what that means with the rule of 72. If the market returned 10% and you only captured 6 because of bad timing, your doubling time went from 7.2 years to 12. Over 30 years, that's the difference between 4 doublings and 2.5 doublings. You lost a doubling and a half just by not staying calm. That lost doubling could represent 40 to 60% of your total possible wealth. And here's the painful part. Most people do everything right. They pick good funds, they minimize fees, they contribute regularly, and then a recession hits, their account drops 30%, and they sell everything because they can't watch it go down. What they don't realize is that selling locks in the loss and resets the compounding clock to 0. The investors who build real wealth understand something different. Market downturns are temporary. Compounding is permanent. They don't just stay calm, they buy more. Here's what all 5 factors add up to. You're not just trying to earn a higher return, you're trying to shorten every doubling cycle by as much as possible, so you can fit more cycles into the same amount of time. Most people drift through investing with 1 doubling cycle, maybe 2, comfortable, modest, forgettable. The people who follow all 5 of these factors, who maximize return, fight inflation, cut fees, contribute regularly, and never panic. They stack 4, 5, 6 doublings over a lifetime, and each doubling adds more absolute wealth than all the previous ones combined. Picture yourself 20 years from now. Do you want to look at a number that grew slowly in a savings account? Or do you want to see What happens when 5 or 6 doublings stack on top of each other? That difference isn't luck. It isn't inheritance. It's 5 levers. And every single one of them's in your hands. Start today. Open your investment account. Automate a monthly contribution. Check your expense ratios. And the next time the market drops, remind yourself, the machine doesn't need your help. It needs your patience. The doubling cycles are already running. Don't stop them. Think about it. If you've made it this far in this video, it means you're not just looking for a quick tip. You're serious about understanding how wealth actually builds. So tell me in the comments, using the rule of 72, how long does it take to double your money at the return rate you're currently earning? Subscribe to this channel for more content that breaks down the math most investors never see. I'll see you in the next one.